So let me start again. So you have a discounted cash flow valuation, you need D and a CF. Now normally think, what's the big deal? You tell me how you estimate the cash flows, I'll tell you what the right discount rate for your cash flows is. Now, when we get to currencies, you know how this is going to play out, right? You're valuing a Turkish company. You decide to value it in Turkish lira, your discount rate has to be a Turkish lira discount rate. You value the same Turkish company in US dollars, your discount rate has to be US dollar discount rate. That's a consistency issue. You decide to do everything in real terms rather than nominal terms, in which case inflation is not built in. Your cash flows have to be real, your discount rate has to be real. But I'm going to latch on to the third measure of consistency that is a little trickier, a little messier to deal with. When you sit down to do a valuation, you think about a financial balance sheet, there are two ways you can approach valuation. One is you can be laser focused on just the equity investors in the company. You can look at the cash flows equity investors get, and you can discount it back at a rate of return that equity investors need to make for being invested in the equity. See, what are you talking about? As an equity investor in the company, what are the cash flows you're entitled to? You might not get them, but what's your measure of cash flows? Anybody want to answer that? You're an equity investor in a company. What's your measure of cash flow? Matthew Gage?
It would be net income / dividends.
Or it could be cash flow. So net income is an accounting concept. We don't even know whether it's a cash flow, but it's whatever cash is left over after everybody else has been paid off, right? Whether you get it as dividends or not it might depend on the management, but you're entitled to residual cash flows. It's cash flows after interest payments, after debt payments, after preferred shareholders. So it's cash flows to equity. And the rate of return you would demand would be whatever cost of equity you would demand given the risk in that equity. If it's a high risk equity, so cash flows to equity are after debt payments, your cost of equity reflects the risk in the equity. But you're right, in a publicly traded company, the cash flow you actually get from the company, there's only one cash flow you actually see, which is physically tangible, which is dividends. The dividend discount model is a special case of an equity valuation model. It's a special case because you focus on what actually gets paid out, even though you're entitled to the rest of the cash flows. So one way to do valuation is to focus on equity cash flows, discount them back at a rate of return equity investors demand. But remember, there are two ways you can fund a company. You can use equity or you can borrow the money. When you borrow the money, I'll take the role of the bank. When I lend you the money, do I get some cash flows from you as well? I certainly do. Courtney, what are the cash flows I get as a lender to a company? You're a bank, you lend to a company, what are the cash flows I collect every year? Interest. And if debt is due, it's principal repayments, right? I get cash flows as well. I might charge a different cost because my claim is a contractual claim. But here's what I want you to think about. What if I looked at the company, instead of just looking at the equity, I looked at the entire company. I looked at the collective cash flow. The collective cash flow equity investors and lenders get. Equity investors get that residual cash flow. Courtney, as the lender, gets interest and principal payment. That collective cash flow, which is a pre-debt cash flow, because debt is now part of what supplies capital to me. That pre-debt cash flow is called the cash flow to the firm, which will be much bigger than the cash flow at equity because it's before debt payments. If that is the cash flow I'm discounting, though, what discount rate should I use? When I did just the equity cash flows, I looked at the cost of equity. But when I'm looking at the collective cash flows that equity and lenders get out of the firm, Courtney, what do you think I should use as my discount rate?
Cost of capital?
A weighted average of what equity investors want and what you want, which is the cost of capital. Cash flows the firm, discounted the cost of capital gives me the value of the entire business. We'll come back and talk about when would I use one approach over the other, but they're both consistent. This is valuation 101, right? Usually you get in the first or the second class. You think everybody would know it. So today's test is about an M&A valuation that was done a really long time ago. But I'm picking this not because it's unusual, but because it's so common. It happens all the time. So let me set the stage here. It's the 1970s. A company called Kennecott, a copper mining company, was required to divest itself of a coal subsidiary called Peabody Coal. The antitrust laws kicked in. So they sell off Peabody Coal. They get $600 million in cash in return. Now, this is a $3 billion company. $600 million in cash means that 20% of the company is now cash, and the company is now terrified. What is it so scared about? What's the problem with having a lot of cash at a small company? What were they afraid might happen?
You're a takeover target.
That there would be a takeover target. Now, let me ask you a follow-up question. You have $600 million in cash that you have no use for. What's the most sensible way to get rid of cash that you don't have a use for?
Acquisitions?
You're a banker, obviously. I asked the most sensible way. The most sensible way to give up the cash is to give it back to the people who own the company. The shareholders give it as dividends, give the money back. That thought never even crossed their minds. They said, what would shareholders do with that cash? Do stupid things like pay off mortgages, buy a car they need. We can't allow that to happen. Let's do an acquisition. I was going to ask, what is the stupidest and quickest way to get rid of 600 million cash? The answer would be, let's do an acquisition. So they went to a bank, not any bank, but First Boston. And in the late 70s, First Boston was the premier M&A bank on Wall Street. In fact, it was co-headed by two men. You know what the names were? I mentioned them already in this class in a very bad context. Bruce Wasserstein and Joe Perella. Remember we talked about Wasserstein, Perella, and I told you these guys couldn't value a $20 bill in a brown paper bag. That Wasserstein and Perella. So you walk into a bank saying, look, I have 600 million in cash I don't have a use for. Can you find me a target I can buy? What kind of answer do you think you're going to get? It's like walking to Bloomingdale's with 5,000 cash. I need to spend this by 5 p.m. I promise you, you'll be surrounded by salespeople. They work on commission for the rest of the day. So First Boston said, not a problem. We're the premier M&A bank. We can find you the perfect target. And they did. A company called Carborundum Universal, a company that makes sandpaper and other abrasives. And coincidentally, the price that Kennecott would have to pay for Carborundum was roughly equal to the amount of cash they had on the balance sheet. This is one of those strange coincidences. You go to a bank and say, I have $1 billion in cash. Can you find me a target? Magically, the target will appear that will cost exactly $1 billion. And First Boston, to convince Kennecott to do this, also did a valuation to show they were getting a good deal. This was the page that showed up. You're saying, how do you get your hands on this page? Well, this became a Harvard Business School case. You know that at Harvard, every case is a strategy case. Nobody talks about prices. It's about fitting, all these companies together. So this was one of those exhibits you ignored in the case if you're actually discussing it at Harvard. But this was the only page, if you ask me, the entire case that actually had some relevance here. So I latched on to the numbers. I'll take you through the process by which First Boston estimated cash flows. And I want to listen very carefully because at the end of the process, I'm going to pose a question to you about what discount rate to use to discount these cash flows. So here's how First Boston got the cash flows for Carborundum. They started with the revenue, subtracted operating expenses, came up with operating income. Then they subtracted out interest expenses to come up with net income. Then they did the usual banking dance of adding depreciation, subtracting out capex, as well as debt repayments to come up with their measure of free cash flow. Now, so think about how I defined it, because now I'm going to pose the question to you about what discount rate is the right discount rate to use on these cash flows. You have two companies. There's an acquiring company, Kennecott. There's a target company, which is Carborundum. Each company has a cost of equity and a cost of capital, and the combined company, once you've done the merger, will also have its own cost of equity and capital. So the 6 possible numbers I'm going to throw at you. And only one of these numbers is the right discount rate given how I've computed cash flows. Let's see if you can nail the discount rate down, right? So first choice, let's make this easier. Cost of equity or cost of capital? Let's get that out of the way. Allison, Lochner, cost of equity or cost of capital? You can pass if you don't feel comfortable.
I think equity.
And tell me why. What did I do with the cash flows that led you to pick equity? How did I describe estimating the cash flows?
I'm going to pass on that part.
Okay. Anybody want to jump in? What did I say? How did I say I got the cash flows? I started with revenue, subtract operating expenses. Then I also subtracted out
Interest expense and debt
expenses,
repayments.
which basically means I'm looking at cash flows left over after debt payments, which is cash flows to equity. So you're right, it's cost of equity. So the cost of capital, you can draw a line through because it's not the cash flows after interest payments. Now comes a trickier question, because this is a question that half of all M&A deals get wrong. Whose cost of equity should I use to discount these cash flows? And I'll give you the three choices. I could use the acquiring company's cost of equity. Why? Because they're coming up with the money. I could use the target company's cost of equity, because that's where the cash flows come from. Or I can use the merged company's cost of equity, because after all, after the merge, it's going to be one company. Anybody going to M&A? I'd like somebody who's planning to go into M&A to answer this. Zach, do you want to try? I know you might not. I saw your cat wander across. So I thought I might pick on you.
Sure. So when we are looking at the combined cash flows, or
Wait. Oh, are we looking at the combined? I told you how I got the cash flows. Was I looking at the combined cash flows? I told you I was starting with carborundum revenues, carborundum operating income.
Okay,
So
yeah.
there is no combined, right? It's like a project. And what was the rule in capital budgeting? When you're looking at a discount rate for a project, it should reflect that risk of that project. Remember that from corporate finance? This is a very big project. Cost of equity you should be using should be the target company's cost of equity, which in this case is 16.5%. If that sounds sky high, remember this was the late 70s where T-bond rates were 8, 9, 10%. 16.5%. So that was easy, right? What do you think First Boston ended up using as a discount rate? What's the worst possible discount rate you could pick? Instead of cost of equity, you pick cost of capital. Instead of target company's cost of capital, you pick acquiring company's cost of capital. You know what they ended up using to get their present value? The cost of capital for Kennecott of 10.5%. You take their estimated cash flows, don't change a single assumption, use the right discount rate on those cash flows, you'd have come up with a value of about $450 million. And remember, you're paying $600 million for the company. You just advised a company to overpay by $150 million because somebody somewhere forgot to ask, are we using the right discount rate? And for this First Boston, got investment advisory fees. They actually made it to the top of the list. You know how at the end of every year they do these deal tables? First Boston was up there. And how did we punish Bruce Wasserstein and Joe Perella for this ineptitude? We let them create their own boutique investment bank that specialized in M&A. You can't even make up this stuff. And they ruined valuation for 15 years. And then they must have both gone to jail, right? No, that didn't happen. You know what happened to Wasserstein Perella? They were acquired by Dresdner Bank, multiple $1 billion. And again, I'm not making up stuff, for their valuation expertise. Bruce Wasserstein had a nickname, it's called Bid 'em Up Bruce. His view was to get the deal done first, worry about price afterwards, as if that's going to do anything for you. I want you to remember this page and the fact that what was then the leading M&A bank on Wall Street screwed up on a very, very basic principle in valuation. Now, some of you might think they probably knew what the right thing was. I'm not convinced that's true, because here's what happens. In M&A, you work as a group, right? You're the group that's doing this. Half the group goes off and does the cash flows. The other half goes on and does the discount rate. 15 minutes before deadline, they both come together in the same room. Each thinks that they've done the right thing, but by combining those two, you've essentially created an almost useless valuation. So later when we come back to M&A, we'll talk about special. What if you have synergy? Because as Zach mentioned, there are some cash flows that accrue to the combined company, like synergy. There you could talk about using a combined company's cost of capital. But when you're valuing the target company, the acquiring company is not even in the mix. It's all about target company risk, target company cash flows, and what the right discount rate is for the target company. Any questions?
Professor, I had a quick question. I just want to clarify. My name, Lauren, by the way, nice to meet you. So I just want to confirm. So you use the cash flows for Kennecott, the acquirer, and they were equity cash flows, so it makes sense for cost of equity.
No, I did the cash flows for the target company. The acquirer is not even a play, right? You're buying the target company, saying, how much should I pay? So when you say the cash flows for the acquiring company, I'm not sure what that means, right? Because you're buying a target company. The cash flows are the cash flows you estimate for the target company.
Okay, got it. Sorry, I was unclear based on the table that we were
because the
looking
acquiring company is not even in the mix. It's the target company you're buying. So when banks value companies, it's always the target company value. Later, when you do synergy, you might talk about bringing in what the acquiring company gets out of it, but it's a side benefit.
Perfect. No, that makes sense. Thank you.
I have a question.
Go on, Lauren.
It's Julie. How?
Oh, sorry, Julie. Go ahead.
How do you hold the? It sounds similar to what you were saying about investment banks in the last class. Obviously, a little bit different of a situation. But how do you hold the middleman accountable?
But not by ultimately making a decision. I mean, I'll give you an analogy. It's a really stupid analogy, right? You go into an electronics store, you find a salesman, and you tell him, can you tell me the best TV for me? I'll predict what he's going to point to, the 70-inch plasma TV. Why? Because he gets the biggest commission. That's how you listen to him. You buy the 70-inch plasma TV, you bring it back to your tiny studio apartment, you can't get it through the door. You call the guy and say, hey, why do you sell me this TV? He said, look, my job is you told me what's the best TV. I don't know what you want. Ultimately, it's your money. You cannot let the middleman tell you what your decision should be. But I'll give you a simpler problem. Where is this problem coming from? It's coming from the fact that deal makers are also the deal analysts. You know what I mean by that? The banker who's making money on the deal is also the one telling you whether the deal makes sense. We need to start with that. You cannot be both deal analyst and deal maker. That's a conflict of interest. That seems to be a fundamental problem in M&A. And that problem, unless it's fixed, is going to create a lot of bad advice. And it's already starting to happen in some parts of the world where you have to separate deal making from deal analysis. But as long as the two are mixed together, I think we'll just get bad advice all the way down the line. Any other questions? Okay. So let's turn to the first lecture note packet. If you have it, great. If you don't, not a big deal. You can download it when you get a chance. So let's talk about intrinsic valuation. I laid the foundations in the intro class, but in intrinsic valuation, you value an asset based on its fundamentals, its cash flows as a business. For cash flow generating assets, it'll mean that you have to come up with the expected cash flows on the asset. And you have to come up with a risk-adjusted discount rate, or the uncertainty has to be somehow adjusted. More uncertain cash flows are worth less than less uncertain cash flows. There are actually two ways you can set up discounted cash flow valuation. One way you see all the time, the other you don't see as often. We're going to talk about why. In the first, here's what you do. You project out your expected cash flows. And those cash flows can be negative early on, but eventually they turn positive. You get expected cash flows in the numerator. And in the denominator, you have a discount rate that reflects your risk. So higher risk cash flows will go with higher discount rates. Typically, that's how people think about discounted cash flow valuation, is the discount rate carries the burden of carrying risk. The cash flows are expected cash flows. But there's another way you can do discounted cash flow valuation that's completely consistent as well. instead of using expected cash flows, you use what are called certainty equivalent cash flows. Have you seen this show with, what's his name? Let's Make a Deal, where they have suitcases and you make a deal as to whether you want to take what's in the suitcase or bet on 3 other suitcases? No. But basically, here's how it will work. I have 2 suitcases. Now let's play this game. One suitcase has $1 million. And Sergio, you're going to be my lab experiment here. Sergio, so one suitcase is $1 million, the other suitcase is nothing. And I offer you a choice. You can either bet on one of these 2 suitcases and accept the randomness that comes with it, or I'll give you a fixed amount of money. How much would that fixed amount of money have to be? Sergio, let me put that back on you.
500,000.
Would you accept 500,000?
I would accept 500,000.
I wouldn't give you 500,000. You know why? Because 500,000 is certain, and now you're replacing an expected bet of 500,000 with 500,000. So here's how I think it's Howie Mandel who does it. He says, "Would you accept 400,000?" And already you can see your brain going, "I can take the 400,000, but then if I get the $1 million, I'll feel bad. But if I turn down the 400,000 and I make a bet and I get nothing, I'll feel even worse." That 400,000 that you accept is called a certainty equivalent, because what you've done is replace an uncertain bet with a guaranteed amount. I mean, this goes back about 300 years. Economists noticed that when people were offered bets, they want and were given a certain amount in replacement, they would accept a lower certain amount than the expected value because we're risk averse. You say, how do I do this in valuation? Let's say you sit down to value Coca-Cola. And I come up with an expected cash flow of $1 billion next year. It's expected, right? There's risk in there. And then I said, how much would you accept as a certainty equivalent? Now, clearly, you'd love to get the $1 billion as a certainty, but you're not going to get it. You might say, look, I'll take 800 million instead. That amount will depend on how risk averse you are. The more risk averse you are, the less you will accept. But a certainty equivalent, what you do is you take each expected cash flow, and instead of using the expected cash flow, you replace it with what you would accept as a certain equivalent. The riskier the expectations, the lower the certain equivalent has to be because you're risk averse. I know it's incredibly messy to even think about doing this for 10 years of cash flow, but let's say you could do this. You've now replaced your expected cash flows with certainty equivalent cash flows. What's the discount rate you would then apply on those cash flows? The cash flows are certainly equivalent. So you know what discount rate you would use? The risk-free rate. And if you do it right, you'll actually get the same answer, because the same risk aversion that leads you to push up discount rates is the risk aversion that tells you how much you would accept as a certainty equivalent. Very few people do the second approach, the certainty equivalent approach, because it's really messy. But a lot of people end up double counting. And I'll tell you how this happens. How many times have you seen a valuation where the analyst says, I'm going to use conservative estimates of cash flows? You know what I mean by that, right? Basically, they say, I'm going to take the expected, but I'm going to use a lower number because I'm conservative. And then discount those cash flows at a risk-adjusted discount rate. You can't do that. That's not right, because you double counted risk. In fact, whenever I teach these sessions to old-time value investors, one of the things that I hear from them is that Warren Buffett has said that he uses the risk-free rate to discount cash flows. And Warren Buffett says a lot of things, and some things he means and some things he doesn't. But this is one of those things he said about 2 decades ago, that he uses the risk-free rate. Why? Because he doesn't like betas. We know he doesn't, all the things he doesn't like, so he uses the risk-free rate. And I said, that might be true, but if you looked at what kinds of cash flows he actually discounts. Because what Warren Buffett also says, when he looks at a company, he counts only those cash flows that he believes will be delivered. In other words, the rest he says are speculative cash flows. He's in effect using an intuitive version of certainty equivalence. And if you do that, you can use the risk-free rate. Make your choice early. If you're going to do with traditional discounted cash flow valuation, your job is to get expected cash flows, not conservative estimates, not lowball numbers, but expected values, and then adjust your discount rate for risk. Any questions? So let's look at these as equations. So in a traditional expected value of an asset is expected cash flows discounted back at a risk-adjusted discount rate. In a certainty equivalent version, you take certainty equivalent cash flows and discount them back at a risk rate. I mean, often when I value companies, as you know, I post my valuations on my blog. People push back. They don't like, my growth rate, my discount rate, and I'm perfectly okay with that. In fact, I expect people to disagree. But once in a while, you'll get somebody who doesn't even read the valuation. They just accuse me, at least, of being a valuation theorist. You're an academic and a theorist, neither of which is meant as a compliment. But I have to laugh because I know how little theory there is in this class. You know how much theory there is in this class? It's that equation. Everything else about this class is about doing what? Getting better measures of expected cash flows and getting better ways of adjusting discount rate. There is no theory in valuation. It's all pragmatic. We all know how to do valuation almost instinctively. We just fight that instinct. So I want somebody to me by lab experiment, somebody who's never done a valuation before, because I want to kind of illustrate how simple valuation can be at its core. Yossi, have you done valuations before in your working life?
No.
No? I'm going to make you look like a genius, so don't worry. This is going to be set up. At the end of this process, people are going to just come to you for valuation advice. Can you see the envelope and the $20 bill that I have? I'm not a magician, so in fact, I'll pull up my sleeves. I'm going to put the $20 bill into this envelope. Okay. Ready, Yossi? How much would you pay for this envelope?
19.5 or 19.9.
Good. You know the answer I usually get is $20. And you know why that doesn't make sense? If you paid exactly $20 for an envelope of $20, what have you just got out of this transaction? An envelope, which cost me absolutely, I probably stole it from somewhere. It's $19.50. In fact, I would start the bidding at $1. Who knows? I might have some strange disease. I can't read numbers. First rule in valuation, if you know the value of something, never start your bidding at that number. You want to start lower and hope to get it for lower than that value. But let's make this more interesting as we go along. So here's what I'm going to do. I'm going to add things to this envelope. Any marketing people in this room? Come on, somebody, you don't even want to admit to the fact that you're a marketing person. It's okay. You would live it down. Somebody said yes. Okay.
Yeah.
You are? Okay. So here's what I'm going to do. Can you read what's on this?
Brand name.
Brand name. I'm going to put brand name in. $20. Now you have $20 plus a brand name. Marketing people love brand names, right? How much would you pay for this envelope now? It used to be, so let's say the old bidding got it to 20. I've now added brand name to the mix. How much would you pay for this envelope now?
I'd have to know something about the brand name.
Well, I told you exactly. It's a 3x5 card with the word brand name on it.
But what if the brand name is WeWork?
Well, then you'd see it in the cash, right? I mean, you can't just say brand, if it's brand name, how, in fact, we're going to come back and value brand names. What's the power of a brand name? What does it give you? Every company claims to have a brand name. Most of them have no brand name value. So what is it that makes strong brand name companies powerful? What can they do?
It conveys legitimacy, loyalty.
But it's fine. Legitimacy and loyalty, I can't pay dividends with. I have to convert the legitimacy and loyalty into.
So, for example, you would spend less money on marketing than the
You'd
same
spend less
exact
money on marketing, or you would have pricing power. In fact, if you want pure brand name power in front of you, here's what I suggest you do. Walk into a pharmacy. Walk into the painkiller section of the pharmacy. Check out the Bayer aspirin. And right next to it, you'll see a generic aspirin. Aspirin's been off patent, what, like 100 years? Check the prices. They're exactly the same product, right? Bayer aspirin will be priced at twice the price of generic aspirin. But then think of how many times you buy the Bayer aspirin, the Sudafed, the name brand. That is pure brand name power, it's pricing power. Where does pricing power show up? It's higher margins, higher cash flows. All I have here is a 3x5 card, which cost me nothing. I wrote brand name on it, I put it in there. Now that we're playing this game, let's keep playing. What if I added control? Brian Rechtenwald, am I getting your name right?
You got it.
Brian?
Rechtenwald.
I now got $20. We decided the brand name was, it's a $3, but I've added control to the mix. How much did you pay for this now? It used to be $20, but now it has control in it.
Yeah, it's still $20 because you can do whatever you want with your $20 you have now.
I feel terrible saying this to you, but you don't have a future in M&A then. Right? Because in M&A, what's the rule? When the minute you throw in control, what do people do? There's a 20% premium. Who makes up this crap? In fact, a few years ago, I had to do this for a group of M&A bankers at Goldman Sachs. These were seasoned bankers. I put this up, and one of the bankers decides he's going to be clever. He offers me $25. You know what I did? I sold him the envelope. He said, I didn't really mean it. I said, now that's your own money. You feel the pain, right? And what did he do? He paid $5 for a 3x5 card where I wrote the word control. So I'm going to keep moving. I'll keep adding some nice looking words. How about synergy? That's a big one, right? I'll put that in there. Still a 3x5 card. How about ESG? The big movement now. I'll do the ESG. I'm a good company. I'll put that in there too. And then I have two words that I discover. If your job is to sell companies for way more than they're worth, these two words will do the trick for you. The first is the word strategic, most dangerous word invented in business. Because you know what it means, right? The numbers don't fly, but I really, really, really want to do this. A strategic deal is just another word for a stupid deal. A strategic buyer is one who will pay any price to buy a company. Find a nice strategic buyer if you're selling your company, but don't be one. That's strategic. And here's the final word. It doesn't work as well as it did 10 years ago. You're trying to sell a company. You're stuck at 100 million. You're trying to get the buyer to pay more than 100 million. You've tried everything: strategic, synergy, control. He's very careful. He says, no, I'm a disciplined buyer. Throw this at him. What does it say? It says China. It's amazing how throwing in China into a company's description will add an extra zero to your value. 1 billion people, your mind's already multiplying. 1 billion refrigerators, 1 billion automobiles. I call these weapons of mass distraction. I call them weapons of mass distraction, right? Those words come out when people are trying to get you to pay more. So you value the company and you're trying to get somebody to pay for it. How about brand name? How about synergy? How about strategic factors? How about China? So I'm going to state some very simple propositions that kind of get to the heart of intrinsic valuation. Here's the first one. It's called the it proposition. If it does not affect the cash flows and it does not affect risk, it does not affect value. What's it? You name it. In fact, each of those words I put in there could affect value as long as you're willing to do your homework. Let's say control. What's about true value control? I'm not talking about the 20% the bankers use. What is the true value control? Jay Margarita, what's a true value control?
The ability to dictate decisions made at the company level.
The ability to change the way a company is run. So Jay, let's carry this forward. I come to you with a company and ask you to value control in the company. You actually have to value the company twice, right?
Mm-hmm.
Why? First, you got to value the company with the existing management in place with all their flaws. And second, you got to revalue the company with what you plan to do at the company that's different. And presumably, you're going to do a better job, which means the second value is going to be higher than the first one. That difference is the value of control. See already the implications that come out of it? If the company you're looking at is already perfectly managed and perfectly run, What's the value control of the company?
0.
0. The worst run and worst managed company, the big, clearly can't be 20% for every company. What's the value of synergy? Sean, Missouri?
It really depends on if you're going to see any added cost benefit or revenue benefit from the acquisition.
But if
Otherwise,
you step back from the essence
Yeah.
of synergies, two entities come together. They're able to do something they could not have. Keyword is could not have as standalone entities. So if you're going to cut costs on your own, that's not synergy, that's
Right.
control. But if you can combine a company, and because you have overlapping distribution system, you can cut costs, or you can go into new markets, that's synergy. Can you value synergy? You absolutely have to. If you're going to pay $3 billion as a premium, you better value it. So later when we get to M&A, we will talk about valuing synergy. I'll use the InBev, SAB Miller to illustrate this. Largest brewer buys the second largest brewer in the world. How do you value synergy? And finally, on a touchy issue, what's the value of ESG? I mean, we talk about ESG all the time. I see ESG advocates telling me that companies' values will go up if they're good companies. Okay, I'm willing to listen. So if you're an ESG advocate, what do I need to hear from you? What are the two ways ESG can increase value? I'll help you along. What are the two ways to increase value? There are only two, remember, numerator and denominator. I'm kind of giving you a clue. It either has to affect your cash flows or your discount rate. Let's look at cash flow ways. How could being good increase your cash flows? Maybe people will buy your products more because you're a good company. Think of the Patagonia story, right? Where good company, therefore people will pay. Maybe if you're a good company, you have less employee turnover because they like staying in your company, which reduces costs. Or it could be that by being a good company, you're able to raise money at lower rates. Banks lend you money because you're a good company. Or equity investors buy your shares because they want to be shareholders in a good company. It could be lower discount rates. Or maybe by being good, you reduce that risk of catastrophic failure. You know what I'm talking about? I just read yesterday that Vale will be paying out $7 billion to cover, and Vale is a Brazilian mining company. And a few years ago, they had this incredibly disastrous, dam broke, thousands of people died. They'll be paying out $7 billion because of those accidents. Maybe by being good, you avoid those catastrophic accidents, in which case your failure probably goes down, your value goes up. You know what's missing in the ESG discussion? Specifics. People say, well, you're a good company, your value go up. Value doesn't come out of nowhere unless we do the homework of connecting whatever we're talking about to value. It's just going to be buzzwords. There'll be lots of consultants who make money, lots of bankers who make money on those buzzwords, but the company and its investors will see nothing out of it, and society will see none of the benefits. All you get is a lot of platitudes about ESG. In fact, I just finished a paper called ESG. Do you want to sound good or do good? Right now, the choice we're making is we want to sound good. You look at annual reports, we're a good company. Look at all the good stuff we do. If we truly want ESG to make an imprint, we need to fill in the rest of the details. The IT proposition. Any questions on the IT proposition? Okay, let's move to the second proposition. It's called the DER proposition. Let's say you sit down to value a company and you get negative cash flows in year one. Remember, cash flows can be negative. Nothing in a DCF model requires your cash flows be positive. It could be negative next year. You say, that's okay. I'll try 2 years from now. Still negative. 3 years, still negative. Year after year, this is a company with a terrible business model. There are no economies of scale. Your cash flow is negative, 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 negative forever. You know how often I get emails about companies like these? Now, here's how the email goes. I'm valuing a money-losing company. I expect it to lose money forever. Which of your discounted cash flow models do you think will give me a good value for the company? To which you feel like slapping the person around the face saying, you have a money-losing company, expect to lose money forever. You shouldn't be paying for the company. They should be paying you. So let's get that out of the way. You sit down to do a discounted cash flow valuation. Your cash flows are a negative in perpetuity. Let the company go. It's worth nothing. In fact, when the Germany's reunited in the late 1980s, East Germany and West Germany, East German companies were all owned by the government. So the idea was that these companies would now be privatized. So the German government at that once got consolidated as a country, created what was called the Treuhandstaat, whose job was going to be to figure out what to privatize these companies at. And then they started looking at East German company after East German company. And what they discovered is many of these companies had created liabilities and pollution costs that were so large that no matter how you structure the company, the cash flows would never cover those costs. So you know what the Treuhandstaat had to end up doing? They actually had to pay people to take these companies off their hands. So their proposition means don't try too hard. If there's nothing there, there's nothing there. Which brings me to a third and more interesting proposition. And it'll be a good chance for me to nag you again. Remember, I've been telling you to pick a company, pick a company. Some of you have, some of you haven't. The tangible proof is the Google shared spreadsheet still has a lot of empty cells next to it. Let's say you pick a company, you sit down to value it. Anybody want to be anybody pick a young company to value? I promise you, I'm not going to pick on you. Just give me the company, Nobody? Come on, somebody must have picked a young growth company to value. An Airbnb, Slack. Slack, of course, has been bought out already. Sean, who you value?
I went with PayPal. So growing, but maybe not.
But PayPal is profitable. Its cash flows are probably going to be positive because it's getting closer to being a money machine. But if you move further up, anybody valuing Square? No, a little further younger than PayPal. Now, if you pick a young company and you sit down to estimate its cash flows next year, especially if you're optimistic, and you're going to see why this is going to sound so ironic, especially if you're optimistic about future growth, what are your cash flows going to look like in year one? Negative or positive? Sean, you can be
probably negative, likely negative.
And tell me why. Tell me why.
Well, you're likely capital expenditures probably higher in year one.
And why? Because you're optimistic. Optimistic means you have high growth. High growth means you have to reinvest. Your company's business model is still evolving, so the margins are tiny or probably negative. So you take an Airbnb, even the very best young growth companies, your cash flows are going to be negative. It's a feature, not a bug. It's called cash burn. And it freaks people out. Why? Because they've been told that if your cash flows are negative, you can't value the company. So they give up. I can't value Square. It's got negative. Airbnb can't. Because they seem to think the world revolves around the Gordon growth model. In the Gordon growth model, you know what you do, right? You estimate cash flows next year. You divide by R minus G. And they say Airbnb is worth minus 100 billion. What's wrong with your model? To which my response is, what's wrong with you? You've taken a model for mature companies, put in a young growth company. Of course, it's not going to work. But if your company has promise, as you go through time, what should happen to those cash flows? First, your business model is going to deliver higher margins, economies of scale. And as your growth levels off, and this is the ironic part, is as your growth comes down, you get this unexpected bonus or expected bonus, which is you don't have to reinvest as much. Your negative cash flows will become positive. And we value quite a few young companies. And every one of those, you'll see this phenomenon play out. Negative cash flows in year one, year two, year three, and then progressively as you go through, maybe by year five, the cash flows turn positive. And once they turn positive, they start to soar. Can a company with negative cash flows be worth a lot? Yes. If you get disproportionately large positive cash flows in the future. Do you see why they have to be disproportionately large? If you lose $1 billion in year one, you actually have to make 5 or 10 billion in year 10 to make up for it because you got to wait for those cash flows. So don't fall for that. Hey, the company is young, it's got negative cash flow, so it cannot do a discounted cash flow valuation. Nothing in a discounted cash flow valuation says that your cash flows have to stay positive all the way through. So let's revisit that equity versus firm. As we started the class, we're saying you have to make a choice. You can either discount cash flows after debt payments at a cost of equity to value equity, or you can value the entire business. If you decide to value the entire business, but your interest is still in just the value of equity, which is what most of our interest, right? Nobody wants to value Coca-Cola as the company. We want to value Coca-Cola shares in the equity. So let's say you value the entire company. To get to the value of equity, what do you need to do? To get from the value of the business to value of equity? You need to subtract out what you owe, right? You subtract out debt. And if you think about whether the value you're going to get is going to change as a consequence, I'll give you the good news. If you do this right, you will get the same value of equity, whether you value equity directly by taking cash flows to equity and discounting the cost of equity, or you value it indirectly by valuing the business and subtracting out the outstanding debt, if you do it right. And that's a big if. I don't know how many of you have worked in banking, done valuations before. But if you have, I'm going to ask you a very mechanical question. Let's say you decide to value the business, and 90% of all discounted cash flow valuations will tend to be business valuation, not equity. You value the entire company. I said you got to subtract out the debt you owe to get to value of equity. But now my question is a specific one. Which debt should I be subtracting out? I'll give you the choices. I could subtract out just long-term debt. I could subtract out total debt. I could subtract out any debt I included as debt in my cost of capital calculation, because remember, you had to make that choice when you did the discount rate for you, what you used as debt. Or maybe I should just subtract out all the liabilities I have outside of equity on my balance sheet, because it says equity and maybe I should be subtracting accounts payable, supplier credit, all the rest of that stuff. Let's start by ruling out the things you shouldn't do. Anybody willing to take an item off this list? So here, what do you think? Any items off this list that you think you take right off the top as non-starters?
A.
And why? Because investment, I've seen each of these in DCFs. That's why I picked all of them. I've seen them in investment banking DCFs. Why is A a non-starter?
Because any debt should be subtracted from.
Because debt is debt. It's not like if you liquidate the firm, the short-term debt, I would say, no, you don't have to pay me back. It was a short-term debt. What's the big deal? It's debt. I've never understood this line between long-term. It's debt. So clearly, what about anybody willing to take another item? So cross out the long-term debt. Clearly, it's a non-starter. Any other items you want to take off? Yossi, you want to try?
Yes, me again. I thought yes, someone else.
You were lit up, so I decided to pick on you.
I would take D off because working.
I would take D off as well, because subtracting out all long-term liabilities is a mess. You're bringing in current liabilities, which are part of working capital, which should be in your cash flows. So A and D are off, which leaves you with B and C, and they're actually very close. It used to be the big difference between B and C was until 2019, accountants had this mistaken view of the world where if you took leases, they did not treat it as debt, which is absurd. It's always been absurd. So pre-2019, if you remember from corporate finance, we talked about when you did cost of capital, when you looked at debt, one of the points I made was your debt should include all contractual commitments, and that includes leases. Which means that what you saw in C was not just the debt you saw on the balance sheet, but the lease debt that you came up with. If you capitalize leases to do your cost of capital, once you value the company, guess what you're required to do? You have to subtract out those same leases as debt. So C is always the right answer. Whether your total debt is all the debt you have, might let B come in as an answer as well. So once you've decided what you're going to include as debt in your cost of capital, that is the debt you'll be subtracting out to get to value of equity. And if you do this right, your equity value will be the same, whether you take cash flows to equity and discount at the cost of equity, or whether you value the firm and subtract out debt. And if you do this right, it's a very difficult if to meet. In fact, this week's weekly challenge. Did I mention that there's a weekly challenge? One more thing I'm going to throw in the mix. Completely optional. Every week I'll post this challenge where you can try what we did in class, and something that stretches you is about doing that. But I'll give you a very simple illustration of how the two equate. And I made up the numbers here. I've kind of, the things I've made in this example that allow me to come up with the answer that I do, and this week's challenge is going to bring out what I've assumed. So let's suppose I have a firm. I give you the cash flows to equity for this firm for the next 5 years and a terminal value afterwards. And I give you cash flows to the firm. Remember, cash flows to the firm includes cash flow to equity plus debt payments and the value of the firm at the end of 5 years. So I've got cash flows to equity, cash flows to the firm. I tell you the cost of equity for this firm is 13.625%. Awfully precise. You should be getting a little suspicious of how I get that number so precisely, but let's say I know it. And your pre-tax cost of borrowing is only 10%. That's your pre-tax. Remember, cost of debt, because you get a tax benefit, would be lower, and your tax rate is 50%, which means your debt after tax costs you 5%, your equity costs you 13.625%. The value of equity in this firm is 1.073 billion. The value of debt is 800 million. So here's what we're going to do. We're going to first try valuing equity directly, and then we're going to try valuing the entire business and subtracting our debt. Let's see if we get the same answer. So if I take cash flows to equity, so you can go back to the previous page, the cash flow to equity is the second column. If I take cash flows to equity and discount them at my cost of equity, I get a value for the equity of 1,073, which is essentially means a company is fairly priced. Its market value is equal to its fair value. That's cash flow to equity at the cost of equity. If I take cash flows to the entire firm, then I need a cost of capital to discount it, right? And how do we compute cost of capital in corporate finance? We take the cost of equity, we take the after-tax cost of debt, and what are the weights we use to come up with cost of capital? Market value weights, right? And I gave you the market value, 1,073 and 800. You take the weighted average, the cost of capital you have is 9.94%. I discount the cash flow to the firm at, and you can see that discount factor show up, at 9.94%. What I get as a present value of those cash flows is 1.873 billion. I'm almost there. I subtract out the 800 million in debt. I get exactly the same value for equity, as long as I stay consistent. Neat, right? Because essentially I took two different pathways, I end up with the same value. Are there wrong paths I could have taken? Absolutely. You saw that with the Kennecott example. If I mix and match cash flows, and this is the consistency principle I want to emphasize, then all is lost. I don't care how much work you put into your cash flows and your discount rate. If you mismatch them, things are going to blow up in your face. In fact, in this example, if I taken the cash flow to equity and discounted the cost of capital, that's the first Boston mistake. The value that I get for the equity is too high because I used too low a discount rate. I used the wrong discount rate, 1,248 million. If I take the cash flow to the firm and discount the cost of equity, I get the reverse problem. I get too low a number. And if I forget to subtract our debt, God only knows what I end up with. There are lots of bad pathways you can take. So one of the first things I would suggest you do when you see somebody else's discounted cash flow valuation is check for consistency. What currency is the cash flow, and is it to equity or the firm? It's very simple, just to check to see what's subtracted out. That'll give you the answer. And then check to see if the discount rate reflects how the cash flows were computed. Any questions? Okay. So we're going to get started on discounted cash flow valuation. Here's how I'm going to approach. And as I said, the next 8 sessions, we're going to be, in a sense, almost lost in the details. But I want to kind of you to hang in there, because if you don't lay the foundation right, we can't do any of the fun stuff. So we're going to start off talking about discount rates, nominal versus real. How do you deal with currencies? How do you deal with risk? So we're going to start with that. Second step, we're going to talk about how you go from earnings to cash flows. If I gave you last year's financials, let's not get ambitious. Do you know the mechanics of how to get from earnings to cash flows? Third step, we get ambitious. We have to project out future cash flows. How do we do that? What are the processes that we can use? Fourth step, we got to have closure. You know what I mean by closure? A publicly traded company can last forever. You can't estimate cash flows forever. So the way we put closure is we stop at a point in time and we assume cash flows beyond that point in time grow at a constant rate forever. Scary word, but that forever gives us an infinite series in mathematics. And that infinite series in mathematics, 200 years ago, mathematicians solved for the value of that infinite series is we steal that equation, and that of course is the magic of terminal value. Discount rates, cash flows, future cash flows / growth, terminal value. And then we try to decide what's the right model to use for my company. And remember the principle of parsimony, which is there are some companies you can value with 3 inputs. Some might require 15, some might require 25. Less is more. That's the 5-step process. So let's start with how every DCF model looks, and then we'll kind of delve into different variants. In a discounted cash flow model, what you usually know is what your company did last year. Right? So we'll give you financial statements for 2019 or 2020. You can work out what your company did last year. You can compute the cash flows before debt payments, after debt payments. This is purely mechanical, but it still gives you cash flows from last year. The tricky thing is you need cash flows in the future. To get those cash flows in the future, you need a growth rate. And one of the things you have to decide is, are you going to be equity focused, in which case your growth rate will be a growth rate in equity income, net income, earnings per share, or are you going to look at the entire business? One thing I think you need to do almost upfront in your valuation is you got to make up your mind. Are you going to be equity focused all the way through? Or are you going to look at the entire business? Because every single input is going to be driven by those choices. For your discount rate, if you're equity focused, need a cost of equity. And we can go through the mechanics and the models, but essentially the end game is to come up with a cost of equity. If you're trying to value the entire business, you need a cost of capital. Pick a hat to wear. I'm wearing my equity hat. Your cash flows are after debt payments, cash flows to equity. Your growth is in net income or earnings per share. Your discount rate is a cost of equity. And what you get is a present value of equity. If you wear your firm or your business hat, your cash flows are pre-debt cash flows. Your growth is growth in operating income. The discount rate is a cost of capital, and what you get as a value is the value of the firm. So while we think of these approaches as different in terms of mechanics, they share a common root. I mean, every discounted cash flow model, if you think about what you have a cash flow, you have a discount rate, you have a growth rate, and steady state. Every single DCF model builds off the same ingredients. If you have a dividend discount model, your measure of cash flow is an equity cash flow, and you're saying the equity cash flow is what I get as dividends. Your growth rate will be a growth rate in earnings per share, dividends per share. Your discount rate will be a cost of equity. Why? Because dividends are cash flows to equity. And when you get to your terminal year last year, what you're computing is the present value of dividends in perpetuity. Everything is dividend focused. You know the biggest problem with the dividend discount model is? You're assuming that what companies pay out is what they can afford to pay out. And we know that that's definitely, absolutely, completely not true. You know how we know? How do we know companies don't pay out what they can afford to in dividends? What gives them away? In fact, Google told you, we're paying out what we can afford to dividends. We can't afford any dividends. You know it's a complete and absolute lie, right? What gives them away?
Share buybacks.
But what if they don't buy back shares either?
Cash on their balance sheet.
You have $100 billion in cash on your balance sheet. Don't even tell me. Don't even talk about we're paying out what we can. That $100 billion cash is not manna from heaven that landed on your balance sheet. It's a direct consequence of I'm not saying they have to, but don't at least lie to me. We know companies don't pay out what they can afford to. You're saying we're stuck with dividends, are we? Could we estimate how much a company could have paid in dividends each year? Very easily, right? What do we define that as? Whatever cash is left over after every conceivable need is met. You go to the statement of cash flows and you work out, your cash flows from operations. You subtract other financing and the investment, and you're left with $15 billion as accrual cash flows. That is cash you could have paid out as dividends. We call that free cash flow equity, a fancy word for potential dividends. And if you decide to use potential dividends, it's still an equity cash flow, so your discount rate is still a cost of equity. But now your work of forecasting future numbers becomes trickier because you have to project out net income, you have to project out debt. So in a sense, you now have to do the homework of estimating free cash flow equity. But you now have a more reasonable measure of cash flows. And what you get as a present value will still be the value of equity. In your terminal year, what are you assuming? You're assuming your free cash flow equity will continue in perpetuity, you get the present value. So dividend discount models and free cash flow equity models are very, very similar. The only thing is you're replacing its dividends with free cash, with potential dividends. Alternatively, you could value the entire firm, in which case your measure of cash flows before debt payments, before interest, before principal payments. Your growth rate will be a growth rate in operating income and free cash flow to the firm. Notice the subtle shift in emphasis. Your discount rate will be overall cost of capital. And when you get to your terminal year, assuming those cash flows, free cash flows will continue to concentrate forever. So if you look at the pictures of each of these models, you can see the similarities. In the dividend discount model, it's all about forecasting dividends. To forecast dividends, you have to forecast income, and you have to forecast a payout ratio. Very simple process. You come up with expected dividends, you discount them at the cost of equity. What you get as a present value? That's the value of the stock. Oldest discounted cash flow model around is the dividend discount model. John Burr Williams came up with it in 1938. It's been around forever. And for a long time, it was the only model. There are still people out there. If you tell them discounted cash flow valuation, this is the model they're thinking about, a dividend discount model. If you switch to a free cash flow equity model, nothing really changes, right? All you've done is replace dividends with free cash flow equity. Same focus on cash flows to equity. Discount rate is still a cost of equity. What you get is a present value. It's a value of equity. But and I'll tell you why you need this model. If you use a dividend discount model on Google, and I've had people send me this, so what's wrong with DCF? I tried to do a dividend discount cash model on Google, and here's what I got. What are you going to get as value? How much does Google pay out in dividends? 0. So if you use a dividend discount model, you conclude Google. Now we can debate how much Google is worth, but there's one thing I can guarantee you. Google is definitely not worth 0. But he's saying, but if I don't get the cash, and this is the problem people have with free cash flow equity models, is, well, then what value is it? Hey, remember you're a shareholder in the company when you have $100 billion in cash. Whose cash is that? Don't try anything crazy and try to cash your check on against it. But it is if you own shares in Google, you own a piece of that cash. That's what a free cash flow equity model brings in, is even if cash is not paid out, it is your cash, and that cash has to become part of your value. And finally, if you look at free cash flow to the firm models, the big shift is debt is now part of the game. Debt holders are no longer outsiders, they're insiders. They supply capital, they get cash flows. The collective cash flow, cash flow to the firm, gets discounted back at a collective discount rate, which is the cost of capital, to get the value of the business. Now, there are lots of pieces there. You're saying, what is that payout ratio? We'll come back and look at the specifics, but what I want you to see is how much these different models build off the same foundations. Any questions about just the big picture? Because ultimately, when people say DCF, you always have to ask, what's your measure of cash flow? How do you come up with it? What's your discount rate? Because you're testing to make sure that at least they're being internally consistent before you go down the path of saying, what's your growth rate? Do I agree with that? So let's start with discount rates. Are discount rates an integral part of discounted cash flow valuation? Of course, it says discounted cash flow valuation. That said, though, I think we spend far too much time on discount rates and too little time on cash flows. And I'll come back and back up the statement, because if you look at a typical DCF valuation that a team does, whether it's at Deloitte or is it at Goldman Sachs or Duff & Phelps, 80% of the time the group spends on coming up with discount rates. 20% gets spent on cash flows, and that, I think, is a misuse of your time. But I'll lay the foundations for discount rates. It's all about consistency. What discount rate should I use? I can't answer that question unless you tell me how you got cash flows. If your cash flows are equity cash flows, your discount rate is a cost of equity. If your cash flows are pre-debt cash flows, your discount rate has to be a cost of capital. What currency? Well, tell me what currency you got your cash flows in. It's a Russian company. That doesn't answer my question. You can take a Russian company and estimate its cash flows in euros, in which case my discount rate has to be euro. So don't let where the companies incorporate drive this choice. Look at what currency you estimate your cash flows in. Should I do things in nominal terms or real terms? Well, you tell me how you got your growth rate. Do you have a growth that incorporates inflation? It's a nominal number. And let's face it, 99% of the numbers we work with out there are nominal numbers. When you're working to get to real numbers, it's because you take inflation out. So if you're saying, I don't know what I'm using, my answer is you're probably using nominal numbers because you're talking to people and asking, what's your growth rate? No manager gives you a growth rate in real terms. They bring in inflation because it's built into your frame of reference. So let's talk a little bit about how risk shows up in a discounted cash flow model. Your numerator, as I said, is expected cash flows. If this were a perfect world, you take every conceivable scenario for your firm, attach probabilities to each scenario. Your expected cash flow is the expected cash flow across all scenarios, good and bad. I know we're lazy, we don't do that, but that's in theory what expected cash flow is. And in the discount rate, here's the way we're going to build up to it. We're going to start with a very simple and basic building block, which is what rate of return would I make if I invested in something risk-free, guaranteed in this currency? Notice how I framed that question. What did I make on something risk-free and guaranteed in this currency? That's your risk-free rate. Then we're going to ask, what is the price of risk in the market for people investing in equities? That's what a risk premium is, whether it's an equity risk premium or default spread. And then we're going to come up with a measure of how risky is my company relative to the average company. So when you use a beta, don't build up too much around it. That's what a beta is. It's a measure of relative risk. So let's start with what kind of risk we try to bring into discount rates. Because this is, I think, a place where people get stuck. Let's start with the statement. Not all risk that you face when you invest in a company is created equal. In fact, I think of risk in a company as falling into one of three buckets. Here's the first bucket. Is it economic uncertainty or estimation uncertainty? You say, what's the difference? Estimation uncertainty is uncertainty you face because you haven't done your homework. You haven't collected the data. Economic uncertainty, you can collect all the data in the world, but it's still going to be there. So let's say you're valuing Airbnb. What's estimation uncertainty? It's not knowing what the size of the hotel market is and doing but after you've done all of that homework, do you think uncertainty is going to go away? Of course not. 90% of the uncertainty you face in valuation is economic uncertainty. What I'm trying to prepare you for is something that will frustrate you, which is those of you who are numbers-oriented, quantitative people. You will collect information expecting to get more certain as you do this. You say, if I do this, I'm going to feel more comfortable, right? And I'm telling you, you're not, because here's what's going to happen. You're going to collect all of the information you want in your company. But after 2 or 3 weeks of collecting the information, you know what you're going to discover? You're even more uncertain than you were before you started, because now you know all the things you don't know. That could change. That's okay. Second, uncertainty can be micro uncertainty or macro uncertainty. What's micro uncertainty? It's uncertainty about what this company will do, what the competition will do, what the managers will do. Macro uncertainty comes from outside. When will the shutdown end? What will the economy look like when it comes back? What will the Fed do? Where will interest rates go? That's macro uncertainty. You say, why bother? Macro uncertainty is the uncertainty we try to build into discount rates. We'll talk about why. Micro uncertainties we're aware of, but we just let it pass through. That sounds weird. You say, why shouldn't I care about the fact that I'm investing in a biotech firm and there's a big chance my drug won't make it? Of course you should care in your expected cash flow, but you won't be adjusting your discount rate for that risk. And we'll talk about what it is that drives that conclusion. And finally, you can have discrete uncertainty or continuous uncertainty. You know, a classic divide on this one. Let's say you're a US company invested in an emerging market with fixed exchange rates. In a fixed exchange rate, the exchange rate is fixed until it changes. So you have no risk, no risk, no risk until there's a devaluation, in which case you have a big risk. That is discrete uncertainty. If there's a devaluation, there's a big shift. There's none, nothing changes. In contrast, if you're a US company invested in an emerging market with floating exchange rates, every moment of the day your earnings and cash flows are shifting as the exchange rate shifts. Which type of these uncertainties do you think we're better at dealing with in finance? Continuous uncertainty or discrete uncertainty? Almost every single risk and return model in finance is devised to deal with one of these types of uncertainty and almost ignores the other. We're very good at dealing with continuous uncertainty. That's what risk premiums, betas, they're all designed. One of the things we're going to talk about is how traditional discounted cash flow valuations significantly miss the effect of failure, where a company might not make it, discrete risk, or nationalization. So with that setup, let's think about how this will play out. Not all risk counts. When you invest in a company, only some of the risk will show up in your discount rate. So don't expect to get rewarded for every risk you face. And here's why. When you think about the risk in a company, you're an investor, and it's going to be very difficult to think about it this way. You can't look at risk through your eyes. You say, who else would I look at that investment through? Look at the risk in the company through the eyes of the marginal investors in the company. Remember in corporate finance, we made a big deal about marginal investors. Who are marginal investors? They're investors who at the margin set prices. They tend to be investors who hold a lot of stock and trade that stock. You're investing in Apple. It's what BlackRock thinks about risk in Apple that'll drive the cost of equity for Apple, not what you and I think. It's something that is very difficult intuitively for people to get because they say, but I am not diversified. That's your problem. Don't expect the market to reward you for something you very easily could have fixed. By doing what? Go buy an index fund. If you choose to put all your money in GameStop, guess what? I'm not going to reward you because you feel incredibly exposed to risk. You chose to do this. You're not going to get rewarded for risk you went out and exposed yourself to. It's one of the fundamental building blocks of how we think about cost of equity for most publicly traded companies. We tend to look at the risk in these companies through the eyes of the marginal investors. And you look at most publicly traded companies, those marginal investors are going to be big institutional investors who are diversified. Whether you like it or not, you and I have to take the cost of equity through their eyes. We can always even out the playing field by choosing to be diversified like they are. But if you choose not to, do not expect the value to reflect that. So I'll set up the models that are going to drive how we can think about cost of equity. And this in a page is every single risk and return model in finance. There's, of course, the standard bearer, right? The capital asset pricing model has been around with us for 56 years. And in the CAPM, to get a cost of equity for a company, start with the risk-free rate. We capture how exposed this company is to risk through a beta, and we come up with an equity risk premium for the overall market. Implicitly, we're assuming you're diversified, so the only risk you care about is the risk you cannot diversify away. Beta captures that. In the arbitrage pricing model, you'll offer multiple betas against multiple factors of market risk, but we don't name the factors. It could be factor 1, factor 2. It's a statistical model. In a multi-factor model, we actually put names, inflation, interest rates as each of the factors. We compute the beta against each one. And finally, there's a subset of models that have emerged in the last 20 years. Where if you ask me the expected return on investment, I throw in proxies for risk. Is it a small cap or a large cap company? Is it a low price to book or a high price to book? Because the history of returns in markets shows you there are some types of companies that seem to earn higher returns. Small companies earn higher returns after adjusting for beta risk than large companies, at least if you go back in time. Those are called proxy models. In every single one of these models, the starting point is the risk-free rate. So if you take the classic CAPM, before you get caught up in betas and equity risk premiums, you need a risk-free rate. So let's at least set up the foundations for risk-free rate. And many of you were in my corporate finance class. We visited this discussion. No harm revisiting that discussion again. You need a risk-free rate. You need a measure of relative risk, which is what a beta is. You need an equity risk premium. Let's start with the risk-free rate. The definition of something being risk-free is you're guaranteed the return you will make. I'm going to leave you with that scene. That is what a risk-free investment is. But already you can see, then I ask you, what's a risk-free rate? Before you answer, you need to ask me some questions, right? First, in what currency? There is no one global, I've seen even people talk about a global risk-free rate. That is absurd. There is no such thing as a global risk-free rate. Risk-free rates have to go with currency. If you ask me, what's a euro risk-free rate? What's a dollar risk-free rate? What's an Australian dollar risk-free rate? Even a Venezuelan bolivar risk-free rate? I can try, but first, in what currency? Second, over what time period? A risk-free rate for a 6-month investment can be very different from a risk-free rate from a 10-year investment. And finally, just because you give me a government bond rate doesn't mean you give me a risk-free rate. Often when I ask people, what's your risk-free rate in Indian rupees? They say the Indian 10-year government bond rate is 8%. I say, well, it might not be risk-free. Why? Because governments do default even in the local currency. So next session, when we start off, that's what we're going to start with, is building up, getting the risk-free rate. Because without the risk-free rate, everything else becomes academic. Getting that risk-free rate nailed down before we get ambitious and seek out betas and risk premiums. So I will send you the weekly challenge, sometime by tomorrow maybe, so you can try it out. As I said, it's completely optional. I think I'll send it out Wednesday. That way tomorrow you get the valuation. Incidentally, you guys did a great job on the GameStop crowd valuation. You're almost 250 people who valued the company. Did you check out what the median value was? Anybody? It's about $19 to $20 across the 250 people in the two classes. The highest value, I think, was 56, which actually puts us in a very strange spot. You know what the stock was trading at close of trading? I don't know what it's trading at today, but at close of trading on Friday, it was trading at 63. 250 of us all thought 63 was too high a price. The lowest value was $1.50 or something. So, but since I asked people to write the stories, you did this, and in a sense, even if you're not comfortable with all of the mechanics, you can get your hands dirty. So I'll put out my next valuation of the week tomorrow. I'm not sure, maybe I'll do Airbnb. More interesting company in terms of growth. So I'll put up my Airbnb IPO valuation with a few tweaks, and you can try valuing Airbnb and see what you get. But that's about it, and I will see you on Wednesday. Any final questions before I sign off? Okay.
Thank you, Professor.
Take care. Bye-bye.
Thank you.
Thank you.